Hi there and welcome to Hardman Talks. I'm Larissa Adams from Hardman & Co. And today I'm talking to David Thornton, editor and owner of Growth Company Investor. GCI is an established monthly newsletter focused on small cap investing. Their insight pieces highlight the best opportunities amongst fast-growing AIM and fully listed smaller company shares. This is always such an exciting area of the market, so I'm really looking forward to this. So David, it's great to welcome you to Hardman Talks. How are you today?
I'm very well, thanks, Larissa, and thank you very much indeed for having me.
Great. Okay, so firstly, can you just share a little bit about who you are, your investing background, and what your current focus is?
Okay, well, I worked for 30 years as a fund manager in the city. Started off back in 1982, right at the start of the long 80s bull market in equities, mainly UK focused, always on equities, mainly UK focused, although I did spend 4 years doing the US market in the late 80s, which was very interesting and very helpful, very formative in the way I think about stocks. And then latterly, I spent 6 years doing emerging markets in Eastern Europe. So quite a broad range in the end, but always equity focused. And then for the last 8 or 9 years, I've been writing about it rather than doing it. So focused on UK small caps initially for another newsletter, and since 2015, I've been editing Growth Company Investor.
Perfect. Okay, so we're going to dive right in. Can you give us an equity market overview right now? What are some of the trends and themes that you're seeing?
Well, it's a very interesting time to be answering that question, Larissa. The last the last 12 months, smaller companies, and particularly those listed on AIM, have been underperforming the all-share index, and it's become particularly pronounced since September when AIM hit its high. Small caps listed on the main market have been doing rather better. And I think the reason for this is the shift from growth stocks to value. AIM's very much dominated by what are, to a large extent, good quality growth companies. There are some maybe at the more speculative end in sort of new fuels and alternative energy maybe. But in the main, these are, good quality, profitable growth companies. But they've been underperforming quite dramatically. They've been derated effectively as the markets switch more towards value, which we're seeing in the outperformance of the FTSE 100, energy stocks, obviously given the current background, but also the banks, some of the utility companies and so on have been performing much better. So there's been a real shift from growth to value, which has made life, as I say, a lot trickier for many small caps.
Okay, thanks, David. So in a previous interview from the middle of last year, you did say you thought companies were being particularly conservative with their guidance and reluctant to share just how upbeat they were in public forums like RNS announcements or discussions with their brokers, etc. So to what extent do you think that's actually played out in the last 6 months?
I mean, I think that was that observation has been correct, really, because most companies, there've been the odd exception, obviously, but most companies have tended to come out with results for last calendar year, at least in line with expectations, and many of them have upgraded in pre-close statements, and some have upgraded 2 or 3 times. So I think that observation was was a very fair one, and it was perfectly understandable, to be honest. I mean, we were still 6 months ago, we're still very uncertain as far as how COVID would play out, how the new Omicron variant would be. We came very close to having another lockdown over Christmas. I mean, speaking now in February, that seems slightly bizarre given how the numbers have panned out. But there was a lot of uncertainty around. So I think it was perfectly sensible and fair for management to be a little bit circumspect when setting their expectations. I think at the time that I felt 1 or 2 were really going over the top about it and actually were being quite unhelpful. We're overdoing it, if you will. But no, I think that generally speaking, that the background has been very, a very positive one for companies recovering from the COVID-19 disruptions that we've suffered. There's always the odd exception, and we've seen it with companies who are exposed to inflationary pressures and supply chain issues. I mean, a stock, for example, like IG Design, which is very much a fallen star, has been really squeezed by cost inflation and pressures. So you see it in one or two pockets, but in the main, smaller companies are trading very positively, and we've seen upgrades and encouraging outlook statements.
Yeah, and I think just going back to what you were saying about communication, it's just there's always a fine line between protecting investors and actually just being unhelpful in the way that you communicate the messaging across. Okay, so how would you describe your stock picking style, and how do you approach small cap investing?
Well, we invest in equities and particularly small caps for growth. So I look for companies that are growing, but I want to pay a reasonable price for them. So the acronym is GARP, growth at a reasonable price. I think if you can buy into good businesses being well run, which are growing and have, particularly if they're smaller companies, hopefully they've got many years of growth ahead of them. If management are able to guide them well. If you can buy into that at a reasonable price, not overpay for the growth of the prospects, then you stand a chance of making a lot of money over a long period. I think my approach, I mentioned that long period. Small companies can be very speculative, and that's a game you can play if you want. However, I try to be an investor and have a longer term time horizon. And sit with small companies over the long term and reap the full benefits. So making a slow pound rather than a quick sixpence would be perhaps a way of putting it. So I try to own stocks for the long term, but not overpay for the growth that we're investing in.
Yeah, understood. And I believe that when you were a fund manager, you focused on big caps. So what would you say is the main difference for investors buying small caps versus large cap stocks right now?
I think there are a few things you have to be very very clear about. I mean, the first one is liquidity. Obviously, it goes without saying. If you're a private investor and you're investing in large FTSE companies, you can be in and out with a very fine spread between the bid and offer prices, and you don't have to worry about liquidity. In the small cap world, particularly as you go down the size curve, liquidity does become an issue. It can be quite easy to buy a stock if everybody else is selling it and vice versa. But if you need to exit quickly in a small cap, particularly if the market conditions aren't helpful, it can be a struggle. So you need to be very well aware of those liquidity constraints. And I think that's what leads me to want to take a longer term view on smaller companies, because they are less liquid, because the share prices can just go to sleep between announcements. Share prices can drift. Somebody wants to sell 5,000 shares and nobody's particularly interested, then that can actually knock the stock back. So you have to accept that as part of the game at this end of the market and adopt that long-term approach to investment. I think the other thing as well, which I would highlight, I think is crucially important, is to try and get to know management. I'm very fortunate in editing Growth Company Investor. I get very good access to companies. So I do between 250 and 280 CEO interviews a year. I mean, it's something I really enjoy doing. Get to talk to some very interesting people, but also it gives you an opportunity to really understand the business and really get a sense of the management style and their approach and so on, which is absolutely crucial with smaller companies. A single decision, a single acquisition, a decision to invest in an adjacent market and so on, kind of a huge impact on the fortunes of a small cap, whereas larger companies, much more diversified, individual management decisions are perhaps not going to have quite such an impact. So getting to know management is I think hugely important.
Okay, so I just wanted to ask something slightly off track, but I'm thinking that with small cap investing, maybe sometimes investors have a perception that when you're investing in small caps, you have fast growth and you're seeing faster returns and it's a shorter investment horizon. But it's interesting that you're talking about a longer investment horizon. That's actually part of your investment strategy. So do you think that's actually a common misconception in the markets?
I'm not sure I caught a misconception. I think a lot of people, as you imply, do tend to look for quick speculative gains, and it's a perfectly valid approach to take if that's where you want to go. But I tend to look at equities as long-term things and investment as a long-term game. And I think the beauty of small caps, if you find good ones, is that you can make several times your money over a longer time horizon. You're picking up on a smaller company, £100 million market cap company, in the hope that it's going to become a 7, 8, 900 million market cap company and make many times your investment over a period. So taking that long-term approach, looking at the fundamentals, backing the management, and sticking with them, I think can deliver super normal returns over time, rather than the perhaps instant gratification that a lot of people look for by nicking a quick 20 or 30% from a speculation. Those are available as well in small cap land, but I much prefer to take that longer term view. Equity investment is a long term game, and I think should always be approached in that way.
Okay, perfect. And then the golden question, I suppose, what are the top 3 most interesting stock picks right now for you?
Well, I've chosen 3 names, which are all stocks I've written about a lot in Growth Company Investor, and which are all components of the paper portfolio that I run in the magazine. The first one is a special situation, Circassia. Special situations quite helpful during times like this, as I said earlier on. Stock market conditions quite tricky at the moment, and there's been a real swing away from AIM and growth stocks in general. So companies whose fortunes depend very much on what they do and what the outlook is for that business is quite a nice thing to have at the moment. So this stock is Circassia. The symbol is CIR. They're a healthcare company, and they're under new management. It used to be a real mess, but the new management team have been in place for a couple of years now, have cleaned the business up and focused it down onto one business, which is Niox, which tests for asthma. It's a very simple, affordable test for primary care venues like GP surgeries to test people for a biomarker for asthma. So it's a huge market. Now they've obviously suffered during COVID because of access to GP surgeries, access to hospitals and so on, very well publicized. So there's a lot of pent-up demand out there, and the business should normalize as healthcare access opens up fully. The business, as I say, it's been really honed down to this one operation, very experienced management. They are incentivized. The shares at the moment about 40p. The management's incentives kick in at 62p. This is a natural business for a trade sale at some point. So I think there's very healthy upside here over the next couple of years. And as I say, it really is all down to management just purely executing on this Niox business, with the healthcare background normalizing and with the prospect of a trade sale at the end of it. So I think it's a very, very simple, very straightforward story. The second one I've chosen is a company called Supreme, which came to the market just over, I think, a year ago. And one of the joys of small companies is that management quite often have a big stake in the business. Their interests are aligned with ours. And Supreme's background is as a family company, which has been run by Sandy Chadha for many years now, and I think he still owns about half the company's equity, and he's a real entrepreneur. I mean, he's a real entrepreneur. He's built the business up. He's taken it into new areas. But at the same time, he's not an excessive risk taker. He's really quite conservative about the balance sheet and financing acquisitions and so on. So, he's very much somebody who I'd want to back. They're involved. They have great distribution into retail, particularly value retail, the supermarkets and high street value retailers. And historically, they've distributed things like light bulbs and batteries and so on. But the most exciting part of the business at the moment is is vaping. They sell vaping liquids, which is a very profitable business, and vaping paraphernalia into that value retail chain. And their brand, I think it's 88 Vape, is very much a leader at the value end. Very profitable, still plenty of growth to come from that. And they're taking a similar approach and a similar model into vitamins and wellness products. Again, with a very much a value proposition, and there's plenty of growth to come from that area going forward, sports nutrition and wellness products. And relating back to what I said about a GARP approach, growth at a reasonable price, this is a good double-digit grower, cash generative, on a P of 13 to 14 times and yielding 3.5%. So I think, with that entrepreneurial management, I think it's a stock on again, taking a longer term view, on a 3 to 5 year view, I think will be a much bigger company. And the final one, just to give you a sense of the range of companies on AIM, is a company called Somero, which is US based but listed over here on AIM, and 3/4 of its sales roughly come from the US. It's a company I've known for a long time, since about 2013, 2014. I've been regularly talking to the management team there. Again, they're conservative, they're sensible, but they're also sufficiently entrepreneurial to have generated some terrific growth in this business, which designs and manufactures laser-guided concrete screed machines. Basically, if you're building an Amazon warehouse size of several football pitches, you want a perfectly flat concrete floor, and their machines allow you to lay that very, very quickly and efficiently, and save a lot of money in terms of time and labor and so on. Great margins, good product innovation, hugely cash generative, very disciplined approach to the balance sheet, hardly made any acquisitions, never issued any new equity, been upgraded. Back to the point I was making earlier about conservative guidance. I mean, they've been upgraded probably about 3 or 4 times in the last 6 months. They're on a 6% yield and a P of 11, and growing, very, very solidly. So again, a great example of some of the value that's available in small cap land.
Brilliant. 3 good stocks to mention. Well, I think that's actually all we've got time for. It's truly valuable insight for small cap investors. So thanks very much, David, for sharing your thoughts with us. If you'd like to find out more about David's views, head over to the GCI website right now and subscribe to receive their newsletters. To our viewers, please don't forget to like and subscribe to our channel. We appreciate your time. Please do share your comments below and hit that like button. Otherwise, we'll see you back here on Hardman Talks next time. Thanks.